Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey, everybody, back with Blaise and Olivia. And today we're talking about capital expenditures and depreciation. Not necessarily the sexiest topic, but trust me, this is the number one topic that will get asked in a technical interview if you're applying for banking internships. It touches all three financial statements in very interesting ways. And it is a number one way that people like to test whether you have a true fundamental understanding of these financial statements. So first, what is a capital expenditure? Really what that is any expense where you expect to get some benefit from something over some period of time, but all of the money is due up front. The classic example is you buy a warehouse for cash today, and you expect to use that warehouse for the next 20 years. And this is like a GAAP, generally accepted accounting principle concept, where we're spending money at discrete points of time, but we feel like we're averaging out the use over time. And so we want a financial statement picture that more accurately reflects this averaging out concept. And so why do companies like doing this? Well, if you buy this plant on year one and you incur all of the expense in year one, then that will be great for your tax liability that you owe this year, right? Because you have this huge expense. But then in every future year, you'll be paying all of these really high taxes. And it's also like not an accurate picture necessarily of your business, right? Because you're using up this plant in all of these years, but there's no expense or accounting for it that's showing up on your income statement. So when you hear capital expenditure, your next thought should be depreciation. And what depreciation is it's kind of a made up accounting concept to allow you to average out expenses over time. And so if you have a factory that you bought for $100 this year, and you expect it to be usable for the next 20 years, basically what you'd like to do, like what do we like to do? What's like the high level liberal artsy, like best way to think about the expense of the factory over the next 20 years?
Well, say the factory costs $100 and you're thinking it's going to be useful for 20 years. You'd say, all right, how about I pay $5 or how about
exactly.
I include a $5 payment a year for that?
Exactly. And so that is the whole concept behind calling something a capital expenditure and having this line item of depreciation, is that we will have in the first year where we do this thing, we'll recognize a capital expenditure of 100. We will depreciate it by $5 in the first year. And then every year we'll depreciate that capitalized expenditure by another $5. So tell me about, in year one, the impact to the three financial statements of a $100 capital expenditure with this 20-year depreciation life. So we're expensing $5 a year. So in the first year, tell me about what's going on. Let's start with our balance sheet.
Well, with the balance sheet, since you gained an asset and gaining, I guess, like the factory, since you just bought that new factory.
Yep. So what is the value of that factory at the end of the first year, the end of that factory asset?
Wouldn't it be $95 or is that okay?
Exactly. Yep, exactly. And so were there any other changes to our assets before we move on?
The $100 that we paid for it.
Yeah. So now I want to, before we figure out exactly what that number is, I want to talk about our income statement. What we said was one way that like somebody somewhere could account for this is we paid $100. And so we have a $100 expense. And so our expenses are up by 100. And, there's some tax shield we get off of that. So our net profit is like way down this year. But we said, hey, like that's not how we want to show this. We want to average out that expense over time. And so depreciation is an expense. We're going to call it a depreciation expense line item that's going to live above our operating profit line, because part of operating our business is we have a warehouse, and in this year we're recognizing an expense of $5. And so when you hear depreciation, you should think of that as an expense that exists on the income statement. Now, this gets into an interesting concept, which is that the number one metric that people use to measure the ongoing profitability and strength of a business is something called EBITDA, earnings before interest, tax, depreciation, and amortization. And so in this context, what that metric is trying to do is it's looking at our operating profit, which, remember, includes this $5 depreciation expense for our warehouse, and it adds it back. And we can talk about why people do that and why, that's something that people care about or would think is a good idea. But the idea of trying to calculate the EBITDA for our business is they would look at the operating profit, which is the EBIT, and they would add back that depreciation expense that we've incurred. But setting that aside for a second, we have a $5 depreciation expense. So our operating profit is down by 5. And now let's assume we have a 40% tax rate. What's happening to our net income? Olivia, how do you think our net income is changing?
Wouldn't our net income also go down, or
yes, but by how much? If there's a 40% tax rate.
So then would it only be $2?
You're doing mostly the right math. It's $3.
Okay.
Because and it's just easier to do it one. You're like trying to combine 3 steps, I think, in there, or like 2 steps, which is operating profit went down by 5.
Okay.
There's no change to our interest expense. So earnings before tax, our EBIT to our EBT, both down 5. Our tax expense is 40% of our EBT. So our tax expense went down by $2. So if our operating profit went down 5, but our tax expense went down by 2, then what happened to our net profit? It only went down by 3.
Yeah.
So now I want to go back to our balance sheet, because we said we have this new shiny factory that is worth $95 after the first year. We spent $100 in cash on the factory, but what happened to our net income? What did we just say? Our net profit went down by
$3.
Yep. And so let's bridge these numbers, because you can see why this is a popular interview question, because it's like, this is complicated stuff, right? Because we're talking about a $100 shiny new factory that we put $100 of cash for, and we're talking about a $3 reduction to our net profit in the first year as a result of this activity. So I want to talk about our liabilities and equities before I return to our cash, because I think that'll help guide us a little bit when we think about making sure that this all balances. What happened to our retained earnings?
Would our retained earnings also go down, because it's kind of the amount of profit that a company has?
Yep.
Okay.
So, and what did it go down by?
Wouldn't it also have gone down by $3?
Yep. So retained earnings went down by $3. Do we have any liabilities or like anything we owe now as a result of this?
No.
Right. So we know that our total liabilities plus total equity had a net change of -3. So now I want to go back to the asset side and see if we can make the numbers work and balance in the way that we want them to. So we have, on the asset side, there are a couple things going on. We have cash paid for the plant is -100. We have the value of the plant is +100. So those two cancel out, right? What other changes to our cash do we have?
I guess to equal it out, maybe you could, I'm not sure where that negative or that 3 would come from.
on our income statement, what cash payments, if any, changed?
Well, didn't we have that depreciation value of like the $5?
We do, but this is a funny number. It was an expense, but it was a non-cash expense. Depreciation is a made-up number we're using to average out this plant payment. So we already captured that depreciation expense in the minus 100 of cash that we paid for the plant. But what else changed? There's another expense that changed after we changed our depreciation.
Well, if we're changing our depreciation, wouldn't our taxes?
Yeah, we
Okay.
got this tax shield. What was the size of that tax shield?
Well, wouldn't it be $2?
Yes,
Okay.
that is the size of the tax shield. Yeah, it's 2. Which, by the way, like, this is confusing. Like, there aren't people who do this in their sleep. There are people who know how to think through all of these things. And there are people who don't know, who just like are like throw up their hands and say, I don't know. And as long as you're able to logically think through this, that's the key. Now, just to recap, we have retained earnings of -3. So we're looking for a -3 number on the asset side. We have plus 100 of, the value of the factory. We have minus 100 from the cash that we paid for the factory. So we're at a net of 0. And then we have plus 2 of cash. That is the value of the tax shield that we saved. And so now we have plus 2 on the asset side, and we have -3 on the liability plus equity side. And so now we're looking for a difference of 5. And what is that? It's the value that by which we depreciated the factory over the period, right? So we said cash minus 100, factory value plus 100. But now it's been a year and we're saying the value of the factory is only 95 because it's a capitalized expenditure that we capitalize on the balance sheet. So structurally, every year, we're saying that the value of this factory on our balance sheet will go from 100 to 95 to 90. And then in year 20, it'll be 0 because we thought it was going to be usable for 20 years. And now, just to round out the picture, let's talk about our cash flow statement. And just as a quick refresher, our cash flow statement is broken into 3 sections. We have our cash from operations, which is a reflection of basically bridging what we said was our net income to the cash impact of what's going on in our operations, plus our cash from financing, which would include any like debt or equity investments that we took in, and our cash from investing. And our investing includes capital expenditures and things like property, plant, and equipment, where we're buying things that we can capitalize for the purpose of the business. So tell me about our cash from operations. And when we're talking about that, we're talking about starting with our net income. That's what I recommend always doing when you're doing cash from operations, is starting with our net income, which we said was -3. But this is our cash flow statement. So everything's about cash. So now I want you to tell me, are there any non-cash items that we need to adjust out that occurred on our income statement? And by that, I mean, according to our net income statement, we had a net loss of $3. But my argument to you is that there is some cost that we included in that -3 that wasn't actually cash that we paid. So for the depreciation expense that we've been talking about, did $5 actually change hands?
No.
No, $100 change hands. $5 is just this accounting thing that we made up. So we're going to add back the $5. And I want to pause on that because it's a little bit funny what we've done. We've said our net income is -3, but we're adding back $5, which would mean that our cash from operations is technically positive $2, which is funny that we could make our cash from operations go up as a result of an imagined expense, that like of a line item that we created. And we did that, and it's positive $2 because of the tax shield. We charged an expense where no dollars actually changed hands, but as a result of charging that expense, we got to avoid paying real tax dollars. Like those are $2 that stayed in our pocket because of this expense that we recognized. So our cash from operations went up by $2. Our cash from financing, there's no change, like there's no debt or equity as part of this. Our cash from investing, this is money spent on new property, plant, and equipment, or things that go into the capex, capital expenditure line item on the balance sheet. What happened there?
We paid $100, right?
Exactly. Yeah. So cash from investing minus 100. So our net change in cash flow, our free cash flow for the period was positive $2 cash from operations, minus 100 cash from investing, $0 change in cash from financing, for a net free cash flow in the period of minus $98. And by the way, that matches all the line items that we were talking about on our balance sheet before earlier too, right? Like when we were trying to make, the positive 2 and the minus 3 match and everything, we paid $100 of cash for the asset and then plus $2 for the tax shield. And so effectively what we were doing with that balance sheet math was predicting what we were going to show on the cash flow statement. And this gets into a little bit about, when we're talking about valuation, and we'll talk a whole lot more about valuation, but free cash flow for the year was negative $98. But I think we can all agree that when we're trying to predict next year's free cash flow, I think we would agree that we're not predicting another $98 because we already bought the plant. If anything, we're predicting another positive $2 because we're expecting that same tax shield benefit next year because we're expecting the same depreciation expense. And so this gets into the idea that our net profit was negative $3, but on an ongoing basis, we're saving $2 of cash every year.
And that will be $2 every year for the 20-year term?
Yeah. So that's like, if we're trying to predict over the next 20 years, like, what does this business look like and what is it going to do? We already bought the factory. So we're going to predict as a result of the factory that our net income will be negative $3 in every year for the next 19 years, absent other changes and other stuff going on. But the cash flow impact is positive $2 every year. And so it's sort of like, this is a case where you're like, hey, like net income is negative, like they're screwed. And in reality, you might be like, well, maybe they're not so screwed.
That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.